In today's video, we're comparing two powerful ETFs, SCHD and SVOL, to see which one can help you achieve financial freedom the fastest. Stay tuned until the end to compare the performances of these funds and discover which one is the best fit for your portfolio. You won't want to miss the key insights that could change the way you invest forever. Let's start by understanding what these two ETFs are all about and their objectives. SCHD, the Schwab U.S. Dividend Equity ETF, is designed to track the performance of high dividend yielding U.S. stocks. Its primary objective is to provide investors with exposure to quality dividend-paying companies, focusing on sustainability and consistency in returns. On the other hand, SVOL, the Simplified Volatility Premium ETF, aims to provide monthly income by selling volatility, specifically by holding short positions in VIX futures. SVOL is designed for those seeking to capitalize on volatility while earning a high yield, but it comes with a higher level of risk due to its strategy. Next, let's talk about the expense ratios. SCHD has an impressively low expense ratio of 0.06%, making it one of the most cost-effective options for dividend investors. SVOL has a higher expense ratio of 0.50%, reflecting the more complex strategy it employs. When it comes to total holdings and assets under management, these two ETFs differ significantly. SCHD boasts a broad portfolio with around 100 holdings, and its total net assets exceed $40 billion, showing its popularity among investors. SVOL, however, is much more concentrated with fewer holdings, and its assets under management are around $1 billion. Now let's examine the yields and distributions. SCHD offers a yield of around 3.5% with quarterly distributions, making it a reliable choice for those seeking consistent income. SVOL takes it up a notch with a higher yield of about 13% distributed monthly. This makes SVOL attractive for those looking for higher income, but with the trade-off of greater volatility. Looking deeper into their portfolios, SCHD focuses on established, financially strong companies with a track record of paying dividends, making it a solid choice for conservative investors. SVOL, however, includes short positions in VIX futures, which is a unique strategy that can lead to high rewards but also involves higher risk. Now let's get to the most critical part, performance. Here's how they stack up. SCHD has delivered a 1-year annualized return of 13%, a 3-year return of 6%, and a return of 13% since inception. SVOL slightly outperforms with a 1-year return of 14%, a 3-year return of 10%, and a return of 12% since inception. But the real difference emerges when we look at how much your investment would have grown if you had invested $10,000 in each ETF since SVOL's inception on May 13, 2021. Average annual total return with dividends reinvested. SCHD, 5.88% SVOL, 10.89% ending investment after 3.28 years with dividends reinvested. CHD, 12,058, SVOL, 14,931. Average annual total return with no dividends reinvested. CHD, 5.36% SVOL, 8.55% ending investment after 3.28 years with no dividends reinvested. SCHD, 11,865 SVOL, 13,1084 with no dividends reinvested. You would have received all the distributions in cash while still seeing your initial investment grow. This means you could use these dividends to cover expenses like your mortgage, car payments, or even vacations, while your capital continues to grow. So, which ETF is better? SVOL is likely the better option for income-focused investors willing to accept higher volatility in exchange for higher monthly dividends. But remember, investing always comes with risks, and it's essential to consult with a financial professional to determine which investment aligns best with your goals. If you found this comparison helpful, make sure to like the video, subscribe, and hit the notification bell so you don't miss out on more tips and strategies to accelerate your path to financial freedom. Until next time, stay informed and keep exploring those dividends.